Required minimum distributions, or RMDs, are the bane of my existence. These are the things that push so many retirees into a significantly higher tax bracket than they probably would have been otherwise. I see it all the time. Retirees work for 40 years and they do exactly what they're supposed to do. They save really well and they save in a tax advantage retirement account. 401k, simple IRA, traditional IRA, something along those lines. And that works out great. They get to retirement, and especially if they have pretty low expenses, they don't really need to take distributions from their IRA. So it continues to grow, and that works great until they hit 73. And I say 73, in the past it was 70 and a half, and in a couple of years it's going to go all the way up to 75. But that's the age at which you have to take required minimum distributions. What is an RMD? It is the way that the IRS ensures that they tax your retirement savings. That's all it comes down to. It's a way you have a pre-tax money that has never been taxed. It's grown for 40 years. And then the IRS says, hey, mighty nice pot of untaxed money you have over there. Be kind of sad if we had to take a little bit of that. And that's what an RMD is. You take that money out of the account, and when you take it out, it's taxed. But what I want to show you today is how is an RMD calculated? Because there's a lot of misconceptions here, a lot of misunderstandings, and it's really a pretty simple process. So just jump in. This is, I'll call him Jim, my little buddy. Jim is 76 years old, and by the IRS's uniform life expectancy table, he has another 22 years left to live. And this will be important in a minute. He also has an IRA that is worth, it's called $880,000. If you're wondering why I went with 76, 22, and 880, it's because the math works out pretty well on this, and I can't do the rest of the math in my head. So what you have to do is you take the previous year's year-end value. So December 31st value, which in our case is $880,000. You divide that by 22, which is the life expectancy, and that leads to, let's go with the equal sign, 40,000. I'm sorry, 44,000. And that 44,000 is Jim's RMD for the year. He has a few options. Really, he has two options. The first is he can take it out, he can have taxes withheld from it, and then he can spend it, reinvest it, or really use it however he wants. But the full amount of that 44,000 is going to show up on his 1099-R at the end of the year, and it'll all be taxable income. The other option that he has is if Jim really likes to support nonprofits, and he's already giving $44,000 in nonprofits, but right now he's just writing a check. Going forward, he can actually switch so that the entire amount is sent directly from his custodian, where his IRA is held, whether it's Fidelity, Schwab, wherever, directly to the nonprofits that he likes to support. Like I said, that's called a qualified shareable distribution, and when you do that, the beauty of it is it doesn't show up on your taxes. You get a 1099-R that says you took the $44,000 distribution, and that $44,000 QCD does count towards your RMD for the year. It meets your RMD for the year, but it's not taxable. And you don't have to actually itemize your deductions either. So QCDs are a great way to get around not needing your RMD, because there are a lot of people that are in that position. If you have any more questions about RMDs, happy to answer them. Drop them in the comments. Don't forget to hit share, like, and subscribe. Thanks.